Okay, well, welcome everybody. It's 11 o'clock and I think we want to get started timely. So I'd like to take this time to introduce our speakers for today. First off, we have Grethell Anasagasti, a principal in our Miami office who focuses on tax planning for flow-through entities and complex partnerships. Gary DuBoff, a principal in our New York City office who focuses on tax compliance and planning for high net worth individuals and closely held business owners. And myself, Ed Smith, the principal in the Boca Raton office, also focusing on tax and estate-related planning issues for high net worth individuals, entrepreneurs, and closely held business owners and fiduciaries. Want to lay out a couple of the rules of the game today. If you have any questions, there's a Q&A button at the top of the screen. Please feel free to post any questions you have there. And, we have a couple of other volunteers who will try to answer, or the three of us will try to answer during the presentation. If we do not get to your question, we will try to get to you afterwards, or you can contact us via our email, which will be on the final screen at the end of the presentation. In addition, we're going to have 3 polling questions provided during the presentation. You can answer those. You'll need them for CPE credit. So we'll ask those throughout the presentation. With that, what are we going to cover today? The agenda for today, we're going to try to cover a broad array of information in a very short period of time. So we're going to talk about change of administration. We're going to talk about year-end considerations and planning opportunities, maximizing the qualified business income deduction, potential interest expense limitations, PPP loans and their deductibility of expenses. And, if we have some time left over, we'll talk about some estate and gift tax planning. Moving on, we assume there was a presidential election. We all went out and voted in record numbers, but with a lot of litigation out there, we still have, lots of litigation going on, and of course, one case now at the Supreme Court. But when it's all over, we're going to have to assume, at least right now, that we will have a change in regime. We'll have President Biden and Vice President Harris, which means that we are going to have the Georgia special election, the runoff election, is going to be very important. Now, that election doesn't occur until January 5th. So we do not know who is going to control the Senate, and that, will be an important factor. What does a 50-50 Senate split mean if the Democrats win both seats in Georgia? Well, the obvious answer is that with, Vice President Harris as the deciding vote, they would be able to make rule changes, for example, changing the filibusters with 51 votes. But it also means that everyone has a voice and everyone has leverage. So you've got different people, be they Republicans on the right, Democrats on the left, or moderates in the middle of both parties. It could lead to a lot more gridlock or many backroom deals because everyone is going to want to use their leverage. So 50-50 split may not be the best thing that could happen. Then you've got, other comments being made that, I mentioned here Joe Manchin's statement against removing the filibuster. Joe Manchin has already stated that he is against removing the filibuster, so he will not vote for that. He has had some war of words with other folks in the Democratic Party right now. He was not a Trump fan, so it's interesting to see where he's going to sit on things moving forward. He, along with a lot of other members, are up for re-election in 2022. So, it really will depend on how a lot of things are going to flow. Going on to the next screen, we are going to obviously cover some of the various changes that the Biden administration may make. But I wanted to kind of quickly go through a brief instance of how tax laws are enacted and how they work. And when you have deficit spending, the Byrd Amendment, the Byrd Rule comes into play. And what the Byrd Rule does is it restricts what can be included in reconciliation legislation in the Senate. When you go through budget reconciliation, you can pass with 51 votes. But the Byrd Amendment restricts what can be put in there. And if the language does not produce a change in outlays or revenues or increases the deficit beyond the budget window, which is usually 10 years, or makes changes to Social Security, you're going to need 60 votes in order to pass any such legislation. So the 2001 Act passed during the Bush administration went through reconciliation, hence the sunset provisions. Same thing with the Trump Act in 2017. Now that amendment only applies to the Senate, but it should stop the House from also writing provisions that they know will not pass. Now, if it's just a revenue raiser, you only need 50% approval plus one vote. And as long as the Democrats in this case would have 50 seats or can pull over one or two Republicans in the event that it's not split, and Kamala Harris has the deciding vote as vice president, you can get a number of things passed there. I have put a note down for taxfoundation.org as a place if you want to go look at what the plans are in a nonpartisan way to see their effects. It's a great site. While we are likely to have tax changes next year, we are still going to need to focus on what's already in place. And so part of what we're going to have covered today is going to go through that. So it does make for some difficult decisions. With that, I want to move over to Grethell and talking about Section 199A and qualified deductions.
Yeah, thank you, Ed. First we're going to do that polling question.
Yep, I missed that one. So how do you like that? So we got our first polling question. Which topic being covered today concerns you the most? Is it estate and gift tax planning? Is it business tax planning, individual tax planning, PPP loan deductions, or all of the above? Please vote. We'll got a few seconds here to vote. All right. Well, all of the above comes in, in first place, with individual planning being the second-ranked item. So obviously, everyone here cares a little bit about everything. Grethell, why don't you move forward with the pass-throughs?
Sure. Okay. Thank you, Ed. So I think if there's something we can all agree on this year is that tax planning is more challenging and complex than probably ever before because of all the uncertainties regarding the change in administration, the impact that the pandemic has had on certain industries, and the one-time freebies that the CARES Act provided for in 2020. So there's a lot going on, but then again, it is the notorious 2020, so we should have seen this coming. So as Ed mentioned, I will be focusing today on tax planning for flow-through entities. But before we get into actual strategies and action steps, I think it's important to review some key concepts and provisions that impact tax projections and estimates, right? So one of these important concepts is what is known as the Qbi deduction or the 199 Cap A deduction. Okay, so just a little background. Under the Tax Cuts and Jobs Act of 2017, the TCJA as we refer to it, a new deduction was created for qualified business income under this section. And it essentially provides for a deduction of up to 20% of certain types of business income. But the deduction is capped at the greater of 50% of the taxpayer's W-2 wages attributable to the qualified business, or 25% of the wages plus 2.5% of the adjusted basis of certain qualified properties. And we'll refer to that over and over as UBIA. That's that unadjusted basis. So overall, it translates to a potential reduction in the effective tax rates all the way down to possibly 29.6%. So it's a nice break. Now, next slide. So what is qualified business income? So the definition is in the regulations, but basically it is net taxable income from operations. So it's going to include things like non-business interest, non-business dividends, capital gains, income from annuities, REITs, or publicly traded partnerships. So next slide. But even more importantly is the definition of what income qualifies. So basically, any activity that rises to the level of a trade or business is a qualified business as long as it is not a specified service trade or business known as an SSTB. So as long as it's not an SSTB, it should qualify. So an SSTB then is defined as any trade or business involving the performance of services, and you can read here the description, for health, law, accounting, actuarial services, et cetera, But basically, it covers most service-driven activities. Interestingly enough, however, certain service types industries, such as engineers, architects, and real estate brokers, property managers also, those are not SSTBs. So meaning that they do qualify for the deduction, even though they are in the service industry. Also important to note that even if the business is an SSTB, you may still be able to take advantage of the QBI deduction as long as your individual income on your personal tax returns is below $213,300 for single, or $426,600 in the case of married filing joint. So assuming that you do have a qualified business that is not an SSTB, there are certain things that you can do to maximize the deduction. For example, if you have a group of entities and only one or two entities have payroll expense, while the others don't have any of that, then you can elect to aggregate the group so that it is really viewed as one qualified business. And then the entire group can share, quote unquote, payroll, or also, the basis in those assets, the UBIAs. So you can elect to aggregate, and then that's a nice tax planning tool. But in order to aggregate, you do have to show that the group is under common control and that it meets two of the following three tests. The products and services are the same or are usually offered together. The group shares facilities or centralized business elements such as back offices, or the group operates in coordination with or reliance on other businesses in the group. So the grouping just has to make business sense as well. I also want to mention something that you won't find in the slides, which is that the same way you can aggregate, you may also be able to segregate two or more activities that are part of the same entity or part of the same tax filing entity. Now, the requirement to be able to separate activities is that each has to be separate and distinct, and complete and separable books are or can be maintained for each. So this can be really important in the case where you have, for example, one activity that would be qualified and another that is an FSTB. So a common example that you'll hear over and over is the case of an optometrist that also sells glasses, okay? The service component of the doctor is an SSTB, but the sale of the glasses is qualified business. So to the extent that you can keep separate books for each, you can take advantage of the QBI, at least with respect to the retail sales of the glasses, even though the other side, that patient-doctor activity, is an SSTB. Okay. Now, I will say we're still, if we could just back up one more slide, because there is something very important with regards to QBI. I think the single most important tax planning that can be done with regard to this deduction is to make sure that the entity has paid sufficient wages to maximize the deduction. So it's pivotal to have a conversation now with your tax advisors to determine if any additional year-end bonuses should be paid to meet this threshold. Also, with regards to wages, it's important to note that guaranteed payments to a partner in a partnership don't count as wages for QBI, but they do decrease the taxable income of the entity that's used as a starting point for the deduction. So it's almost like a double whammy. And there are a few things or a few planning ideas that can be done with regard to this. One of them is to structure the payments to partners as priority returns instead of guaranteed payments. This way, it still won't count as wages for purposes of the deduction, but at least it won't decrease your income. It won't decrease that starting point, okay? Another tax planning concept that sometimes is considered is to restructure so that wages are paid out of an S corporation to owners instead of out of a partnership to partners, okay? So those are two things that we see fairly frequently. Now, one caveat to both of these ideas is that businesses need to consider that as it stands, the QBI deduction will sunset after 2025. But also, if there is a tax reform under Biden's administration, the deduction would potentially be eliminated. He's expressed that before. So it's important to consider this and keep it in the back of your mind before an entity starts undergoing substantial restructuring or you start revising payment structures, et cetera. It's important to keep this in mind. But on the other side of that coin, unlike many provisions that really just defer taxes, this is really a permanent tax break. So to the extent that you can maximize, you really should. Okay. Finally, it's important to remember that while the deduction is great when the business has taxable income, if the business has a loss, that loss, to the extent that it is not used to offset other qualified income from other entities, is carried forward, and it will reduce future years' income for QBI. So again, keep this in mind before you start paying wages or taking other steps. If you have substantial losses from prior QBI years carrying through, it will eat into your QBI deduction regardless of any other factors. So that's something important to keep in the back of your mind. Okay, so I think we can move on to the next slide. So moving away from QBI, or mostly away from QBI, as you'll see, one of the most talked about provisions of 2020 has been the PPP loan, which, as probably all of you know by now, created a forgivable loan available to businesses to cover the economic uncertainties of the pandemic. Next slide. So fast forward 7 or 8 months from when the loans were created, the IRS as well as Congress, they're still issuing regulations, and they still haven't addressed all of the many questions that were created when the loan even first came out. So one of the best examples of this is the most recent notice issued by the IRS, which is only 2 or 3 weeks ago on November 17th. And it has to do with the deductibility of the loan expenses paid with PPP proceeds. Now, just a little background. Until this notice was issued, many of us believed that expenses funded with PPP loans would be deductible until the time that the loan actually became forgiven. So because of that, many borrowers were hesitant to apply for forgiveness before year end in order to be able to claim the deductions on the 2020 return because it hadn't been forgiven, and then instead assumed that the deduction would be reduced or made non-deductible on the year when they actually had that forgiveness. But then Rev Rule 2020-27 was issued and essentially shattered that tax planning idea. So the notice states that PPP loan recipients who reasonably expect to have their loans forgiven cannot claim deductions for related expenses paid with forgivable loan funds on the tax return for the year in which the expenses are incurred. So that's pretty clear the way that it was worded. Now, it's important to mention here that this ruling has been met with great resistance from Congress on a bipartisan front, since it really flies in the face of what was the congressional intent, which was to make the forgiveness tax exempt. So by disallowing the deductions, Treasury has really turned it into a taxable event, and this can dramatically impact tax projections for the 2020 tax year. So it's a huge thing. But because Congress has widely expressed their discontent with this ruling, it's really not improbable that relief could come as part of the next stimulus package. As a matter of fact, just yesterday, a bipartisan group of lawmakers circulated a framework for the relief proposal that is currently up in Congress. And this framework clearly states, and I quote, "Business expenses paid for with the proceeds of PPP loans are tax deductible, consistent with the congressional intent in the CARES Act," end quote. So it really cannot be more clear that this is what Congress would like to see. However, as anyone that's been following the news recently knows, it's almost impossible to predict what would happen at this point. Time is running out, though, since Congress really needs to pass any relief proposal before December 18th to avoid a government shutdown. So at this point, it's very much a wait and see game. But for the time being, with regard to tax planning, I think it makes sense to take a conservative approach and assume that expenses will be non-deductible, which is important on several different fronts that we'll talk about later shortly. So next slide. Now, in addition to the rev rule that we just discussed, the IRS simultaneously issued a ref proc that provides a safe harbor for taxpayers whose loan forgiveness has been denied, or who have made a decision to forego the loan forgiveness and just pay back the loan. So to the extent that this applies, then the safe harbor states that the expenses will be deductible either in the tax period where they're incurred or in the tax period in which the forgiveness was denied or the decision to forego forgiveness was made. So while this was nice of them, it doesn't really resolve much other than to say, if you disallow the deduction in 2020, for example, and in 2021 the forgiveness is denied, then you can go back and you can claim the deductions on your 2020 return if they haven't been filed yet. If your 2020 return was already filed, you can go amend it and claim the deductions there, or you can just take the deductions in the 2021 return. So it gives you a little bit of flexibility. Next slide. Okay, so before we get off the subject of PPP deductibility, there is one really important concept that needs to be addressed. So as you'll recall from our conversation just a few minutes ago, having the correct amount of wages is imperative for maximizing the QBI deduction. So then the question follows, what happens with wages paid to employees that would count for QBI when those payments are made with forgivable PPP loan proceeds and therefore not deductible, or possibly not deductible? So if you ask many of us, I think the first instinct or the first knee-jerk reaction is perhaps to say that the non-deductibility will not impact QBI wages. Why? Because QBI wages is usually, the way that you compute it is you start with what's on box 5 of the W-2. Therefore, if that amount is going to be on that box, regardless of deductibility, it should count for QBI, you think. But the problem is that using the W-2 as a basis for that computation was a measure from olden days, before the CARES Act and before the madness that is 2020. So you need to look a little closer than that. And when you start looking at the QBI regs, it says that amounts are only included in QBI if they are allowed in determining taxable income for the year. So this really makes you question your first logic, and based on that literal interpretation, it would seem that non-deductible wages will not count for QBI. Now, another detail that has yet to be addressed is how the non-deductibility would be allocated among the several expenses that the PPP loan was created to cover, such as rent. And we can just go back one slide, one more. This is the last comment I have on PPP. But again, yes, it has not been addressed how the non-deductibility would be allocated among the several expenses that the PPP loan really was created to cover, such as rent, mortgage interest, and utilities. So it would seem that they have to issue guidance to determine if that non-deductible portion, for example, if it will be prorated among expenses, or if you'll have the option really to pick and choose. For example, can you make rent and utilities non-deductible first and then put the remainder to wages? So that would be beneficial for QBI, right? But as has been the norm over the past 8 months or so, further guidance is going to have to be issued to determine the impact of this loan forgiveness on QBI. And as I mentioned earlier, but for the time being, I would certainly take a conservative approach, particularly with regard to year-end tax planning. You don't want to be in a position where you didn't pay sufficient wages for QBI because you were counting on the PPP expense deduction and it never comes to fruition. Okay, so that's the importance, and that's what I really want to focus on. So now we can move on from PPP. Okay, so next in line of concepts, I thought it would be a good idea to do a quick refresher on the interest expense limitations, also known as the 163J limitations. And those, again, were enacted as part of the 2017 TCJA. So while this is really an area that is not particularly flexible from a tax planning perspective, because business interest expense is what it is for the most part, there are a few things that can be done. But first, let's talk about what is the interest expense limitation. So this is just a rule that limits the amount of interest that can be deducted to 30% of adjusted taxable income, or ATI. And then you also add business interest income, and you also add floor plan financing interest. Now that last section, that's really geared towards the auto dealership industry. So we won't get too much into that today. But some definitions on the next slide. Can we move to the next slide? We're getting close. I can start. Oh, or maybe I'm stuck. Maybe you guys can see the next slide. So some definitions is business interest. So this is the amount of interest, income, or expense that is allocable to a trade or business. In other words, it's anything that is not investment income. So for example, interest income may be from outstanding customer receivables. That would be considered business interest income. Then a very important definition, the concept of ATI. And that's really what drives most of the limitation. So ATI is basically taxable income with the following items added back. Can everybody see? Is everybody on the right slide? If you guys can send me a chat maybe. It might be that I'm stuck, but I'm still on the previous slide. Oh, yep, I think I am stuck. Okay, just give me 1 second. Let me try to get back there. Okay. Okay, I'm sorry, guys, just give me one quick second. Let me get in there. Okay, so I've been told that we are on the right slide. For some reason, I can't see it on my screen, but I do have a copy printed out. So it's good to be prepared. We'll go that way. Okay, so we were talking about the definition of ATI. And ATI is basically taxable income with the following items added back. You add back business interest income and expenses. You add back depreciation, but only until 2021. Starting in 2022, ATI will be net of depreciation. You also add back any NOL deductions and any non-business income or deductions. So again, this is really like investment type income, such as capital gains, dividends, etc. So after all the adjustments, if you think about it, ATI is almost like a cash flow from operations, right? So I can't see it, but I'm sure we're going to flip to the next slide now. Okay, and so really the concept of the limitation is not very complicated at all, and I don't want to spend too much time on it, but I think maybe a very quick example may help. So here we have ABC LLC that has the following items of income and deductions. It has gross receipts, it has cost of sales, it has interest income and expense and depreciation, so it ends up with net income of $55,000. So going to the next slide, the deductible interest expense is computed by first taking interest income of $5,000, and you put that aside because you will definitely be able to take expense to that extent. And then you compute the ATI, which starts with the $55,000 of net income, and it adds back depreciation, interest expense, and interest income. So the ATI ends up being $100,000, which means that the interest expense is limited to 30% of this amount. So $30,000 out of the total $35,000 will be allowed. The remaining $5,000 is suspended until the entity generates sufficient income to free up this amount in subsequent years. Okay, now there are some exceptions to the 163J limitations. The most significant is the small business exception. And this generally says that small businesses with gross receipts of less than 26 million over the prior 3 years are exempt from the limitation. So this really helps many businesses get out of the rule. But for purposes of the 26 million receipt test, you do need to aggregate all entities that are under common control. So the rules for what is common control are complicated and probably beyond the scope of this webinar. But needless to say, this brings back in many entities that would otherwise qualify as a small business if they were on a standalone basis. Okay. And then finally, the exception to the exception. The small business exception is not available to entities that are known as tax shelters or syndicates. So a tax shelter is defined as a trade or business that allocates more than 35% to limited investors or entrepreneurs. So if your business is considered a tax shelter, you are going to be subject to the interest expense limitation, even if your gross receipts were 100,000, for example, instead of the 26 million. So here's where things really tend to get a little sticky for many of the small businesses. Okay. Now, going on to the next slide, another exception to the limitation is for real property trades or businesses that make an irrevocable election to be exempt from this rule. And these entities are referred to as electing real property trades or businesses. And the price for making this election is that the entity will have to change its depreciation to the ADS method, which is generally only a little bit slower than regular depreciation, so it's not that big of a deal. But there is no bonus depreciation allowed under ADS. So to the extent that you have a real estate entity that makes significant acquisitions of furniture and equipment and qualified improvement property to the interior portions of their commercial buildings, then this election would mean that they can no longer take advantage of the 100% write-off when these assets are placed in service. So the price to be exempt from the limitation can get a little expensive for certain types of entities. Okay, now moving on to the next slide, we're getting to the tax planning ideas, which really is why you are all here today. So, I'm going to talk about some situations that we've seen and some workarounds. One of the situations that we come across sometimes is a partnership that needs to borrow money, and the interest expense on those borrowed monies will likely be limited because they're a tax shelter or because they don't meet the definition of a small business. Now, if the partnership is able to secure the funds from a related party, they may want to consider giving the lender a preferred interest in the partnership instead of structuring it as a loan. This way, there's no interest expense, and the new partner in the partnership is just going to receive an interest in the partnership. So this works, but it only works if the funding member is willing to carry an element of risk. Because if the payments for this use of capital can be viewed as a way to circumvent the interest expense limitation rules, then the IRS will not hesitate to recharacterize that and call it interest instead. So for it to work, the lending member needs to be entitled to a return of partnership income and has certain amount of risks, such as if something happens and the partnership ends up with huge losses, they may not get their money back. So it's not a perfect plan, but it's something to consider. Another tax planning, if we can go to the next slide, another tax planning strategy may work for small businesses, and this is particular for small businesses who are expecting a small amount of loss for the year that would eventually be allocated to passive investors, therefore making it a tax shelter. So when this is the case, these entities would do well to do what I call reverse tax planning at year end to see if they can boost their income enough to get them out of a loss position and therefore getting them out of the tax shelter regime. Now, important to note here, talking about the tax shelter definitions, is that regulations, newly issued proposed regulations, I should say, permit a taxpayer to make a permanent election to rely on the prior year income to determine whether or not it is a tax shelter. So, for instance, it may be that in 2019 you had income and then your industry was affected by the pandemic, and for 2020 you will have a loss and be called a tax shelter. So you can make this election and you can use 2019 income to say you will not be a tax shelter for 2020. Now, the problem that I have with this election is that it's permanent. And those of you that know me know that I have certain commitment issues when it comes to permanent elections. And the reality is it only helps you in that one first year that you make it. So going back to our example, in the case of 2020, it would help you to use the prior year amount. But come 2021, regardless of how the business does, they can be completely profitable. They will be a tax shelter that year because it will be based on the 2020 results, right, which were a loss. So again, not that great for 2021. It ends up hurting instead of helping. So that's my hesitation on this election. But then again, it does simplify tax planning to a certain degree, because as of the beginning of the year, come 2021, let's say, you will already know that you'll be a tax shelter. So you can kind of plan around it where you can. Okay, so moving on. There are also some important changes to 163J that came about from the recent CARES Act, and I thought, we should go over those today. So one of these is that the ATI limitation was increased from 30% to 50% for 2019 and 2020 for S Corps. For partnerships, for some reason, it was a little different. They left it at 30% for 2019, but they upped it to 50% in 2020. But then they threw in a little sweetener that says any partner that receives excess business interest, which is basically their portion of the disallowed interest, they can automatically take 50% of that 2019, only 2019 excess business interest and use it as a deduction on their 2020 returns, regardless of any other income computation. The other 50% is subject to the normal computation. So why they made it so different from S corps and partnerships, who knows? But that's what we have. Another nice tax break is that for 2020, and this is for 2020 only, an entity has the option to use the ATI of 2019 to compute the interest expense limitation. So this is significant, and it's not to be confused with that tax shelter election that we just went over. This is a one-time option, a one-time deal only, available to any taxpayer. And the reason that it's so beneficial, again, for entities with income in 2019 that perhaps will have a loss in 2020, or even lower income in 2020 as a result of the pandemic, the industry, or whatever the case may be. That 2020 reduced income or that 2020 loss will not hurt them for purposes of the interest expense limitation. So it's great, and it can be very significant. But again, important, this is only for 2020 and has nothing to do with that tax shelter election, even though you can see why the concept can be confused. So it's important to keep them apart. And finally, the CARES Act enacted a provision that allows entities that may have made that real property trade or business election that we spoke about earlier. It lets you withdraw that election by filing an amended return. So again, super important, because this is where you'll recall that election was irrevocable, but the CARES Act is giving you flexibility because they made so many other changes. They changed the qualified improvement property. We'll talk about, if we have time, a little bit later. So because they made all of these elections, they gave taxpayers the ability to withdraw those irrevocable elections one time, to the extent that they were made in 18 or 19. So that was a very nice provision that they threw in there. So I think now would be a good time for a polling question, Ed.
Yeah, thank you. So the polling question is, have you consulted with your tax advisor to make sure you are addressing all your year-end tax planning needs? It's a yes or no question. Give it a few more seconds. And the results, 63% said yes, 37% said no. If you have needs, I would recommend getting in touch with them as soon as possible. Our advisors are waiting and anxiously to talk to you, and we'll be reaching out as well. Moving on to year-end strategies, Grethell.
Excellent. Okay, so now before I hand it back to Gary and Ed, and before everyone here is tired of hearing me speak, I just wanted to talk about some practical year-end strategies for these flow-through entities that we're talking about. So by far, the most important thing you can do when it comes to year-end tax planning is to determine the best strategy for your business based on the specific facts and circumstances. There is no one-size-fits-all. And, when it comes to that, income projections or forecasts are the most important starting point. So it's crucial to have an understanding of where the business is expected to end in the current year, in the upcoming year, and to the extent possible, a forecast for a few years down the line really helps too. So once you have these projections, the best advice for any business is to make sure that you reach out to your tax advisor and come up with a really good strategy, a really good fit for your business. And in doing so, you're going to consider a few of these factors. One of these considerations that you have to keep in mind is the 163J interest expense limitations that we were just talking about. So as we discussed, there are some specific instances where you do want to do that reverse tax planning and you want to accelerate income instead of deferring it, okay? So that's something that you want to consider. Something else that's important is whether the indirect or direct owners of the entities will be able to take advantage of the relaxed NOL rules and the relaxed excess business loss rules that Gary will speak to you about shortly. But essentially, if a business is expected to end the 2020 year in a loss position, and it's determined that the owners will be able to take advantage of these NOL rules and it makes sense for them from a tax rate perspective, from several factors that need to be considered, then here you want to do as aggressive tax planning as possible to maximize those losses and bring in those deductions as much as we can to any extent possible. And finally, no tax planning should be considered without weighing in the possibility of a tax reform, as we've been talking about under a Biden administration. So although you heard Ed mention earlier, it's not likely that a tax overhaul will take place unless the Democrats take control of the Senate. We won't know this until January of next year. But, you know, with all things tax planning, you can't do it in a vacuum. You really need to consider everything that's out there, including the likelihood that the tax rates will go up, because it is very likely that the tax rates will go up at some point during a Biden administration. Okay, so next slide. So once you have an overall tax planning strategy, what are some things that you can do to accelerate or defer income? So let's just say that our goal is to reduce taxable income. One of the ways to do this is by refocusing your collection efforts, right? So for cash basis taxpayers, you may want to slow down a little bit of the billing and cash collection efforts at year end. Also, you want to make sure to pay out all outstanding vendors or creditors to make sure that you can take advantage of the associated deductions, right? You also want to consider things like making year-end bonus payments to employees, which not only helps bring down the taxable income, but also may help you with that QBI that we keep talking about. Another thing that's really important to keep in mind that may not be at the forefront when you're thinking tax planning is the repayment of the deferred payroll taxes. So as you all may be aware of, the CARES Act provided for a deferral of employer portion of Social Security taxes, which are not payable for a while to come. So 50% of those deferred amounts are due on December 31st of 2021, and the other 50% is not due until December 31st of 2022. However, you don't have to pay back the taxes, but you can't get a deduction unless you do pay them. So for cash basis taxpayers, in order to get a deduction for these payroll taxes, you have to pay back the amounts by year end, by December 31st of 2020. For accrual basis taxpayers, you have a little bit longer. You don't have to pay those back until September 15th because it's 8.5 months after year end. So you have a little bit more time, but again, can't take the deduction if you don't make the payments. Now, another potential strategy that can be very beneficial is to accelerate the acquisition of assets. So to the extent that you can, be sure to purchase any furniture and equipment before the end of the year so that you can take advantage of that accelerated bonus depreciation, which lets you write off 100% of your acquisitions as long as they're both purchased and placed in service before year end. Meaning you can't run out and buy $500,000 of computer equipment on December 31st, have it delivered and installed in January, and then take bonus depreciation. You can only take the bonus depreciation if it's installed up and running by year end. Also related to bonus depreciation, many of you who again have worked with me or have heard me speak in other webinars, you know how happy I was this corrected qualified improvement property glitch that was there since 2018. Now, just a little background on that in case you're not super familiar with it. Along with the many other provisions of the CARES Act earlier this year, Congress corrected this technical error that they had made in the drafting of prior legislation. And this correction is important because it once again allows you to take bonus depreciation on qualified improvement property, which is any improvements made to the interior portion of commercial buildings used in the trade or business. So again, this is a little bit more difficult to push because construction can't always be hurried along just for tax planning purposes. But, keep in mind any qualified improvement property that is considered placed in service before year end can now be written off as well. And finally, related to a depreciation deduction, if the business owns real estate, this may be a great year for a cost segregation study. And these studies are designed to carve out the cost of the building into separate components eligible for shorter depreciable lives. And they can usually, provide a really good tax savings. So if the goal this year is to maximize those losses and those deductions, this may be a really good way to do it. And what's more, these studies don't have to get finalized until the time that tax returns are filed. So it's not necessary to start scrambling now and get something done by year end, as is the case with a lot of other tax planning ideas. So those are all some of the ideas to consider as far as reducing taxable income. If the strategy by chance is the reverse and it's actually to accelerate income, then these usually work well in the reverse order also. So I won't bore you with more slides. Obviously the idea would then be not to elect bonus depreciation and hold off on certain payments to vendors, hold off on fixed asset acquisitions, et cetera, et cetera. But all of these should work regardless of which approach you're going for. So with that, I will leave you. Before I do, I just want to say, as always, the most important takeaway is that this year, more than ever, it is crucial to have a good understanding of where your business is, where you expect it to be, and discuss with your tax advisor. Make sure that you're on the right path for tax planning. So with that, I will leave you now with Gary, who will go over the importance of tax planning from an individual perspective.
Thank you, Grethell. Get a big glass of water. That was extremely informative, and I always learn a lot from the presentation. And I'm sure there'll be a lot of people who have questions. And just a reminder to everybody to please, if you have any questions, please post them to the Q&A button on the Zoom chat, and we will be sure to answer some of those questions at the end of the presentation. As we all heard from Ed and his legislative overview, there's going to be a lot of uncertainty about future taxes, and I think Grethell also pointed that out as it relates to businesses. So the question is, how does an individual plan with so much uncertainty, from a legislative perspective? And we only have 3 weeks remaining in 2020, so let's just focus on what we do know, right? We know that the laws in 2020, that those laws were passed, many of which were changed when the Tax Cuts and Jobs Act was enacted in 2018, but we do know that some of those laws will expire, and we'll talk about some of them as it relates to estate tax planning, but there's clearly a number of business provisions that will expire in 2025, as well as individual provisions. In a month, we'll know exactly, who's going to control the Senate. Hopefully, we'll have an answer by the end of January. And with that certainty, we'll know which direction we're headed from a tax perspective. But we also know that the cost to repair the damage from the pandemic is going to require a lot of economic stimulus, which hopefully Congress will pass soon and going forward. And this will ultimately result in higher taxes. So the expectation is we will have higher taxes. It's just a question of when. And we should anticipate that if one party controls the Senate and the Congress, then there'll be swift changes On the other hand, if the House and the Senate are split, the changes won't be as dramatic, and they'll probably be more muted and more well-balanced from a tax policy perspective. Next slide, please. So with higher taxes as a backdrop, let's review some of the potential changes under Biden's proposals. And just to point out that some or all of these could become law. So, we kind of have to take it with a grain of salt because we don't know what they ultimately will look like. But here are the proposals that affect mostly high net worth individuals and wealthy taxpayers. And the first is obvious, a rate increase from currently 37% to 39.6% on ordinary income. But not only ordinary income, because under Biden's proposal, he's planning to eliminate the preferential tax rates for long-term capital gains and qualified dividends, which currently range anywhere from 0 to 20%, depending on your level of income. And his proposal would really just impact those taxpayers who have greater than $1 million in gross income. Another byproduct of this change is that it means that separate legislation, which has been on the block, for years to eliminate private equity carried interest benefits, will effectively be eliminated because there's no need to make separate legislation if, in fact, there is no longer a difference between long-term capital gains and ordinary income. Third, there's going to be a restoration or expected restoration of the PPP limitation, which is the 3% floor on itemized deductions. For incomes above $400,000, I think there was a phase out on that under prior law before the PPP limitation was eliminated. And, in addition, they would essentially put an AMT like 28% cap on other deductions that would otherwise be deductible as an itemized deduction. Fourth, and this is an important one for many taxpayers, the current wage base for Social Security is $137,700. There is no wage base on Medicare. That's an unlimited tax of 2.9%. But the proposal is to essentially there would be a gap between $137,700 and $400,000, where the Social Security tax will then kick in at $400,000, and that's a 12.4% combined tax between the employer and the employee. So if you're self-employed, that's essentially going to be a 12.4% increase. But if you are an employee and your employer is paying that cost would be split between the employer and the employee. The next item on the list is obviously is near and dear to Grethell, is the phase out of the qualified business income deduction for taxpayers over 400. We all know that there's an SSTB phase out already at approximately $430,000. But we've been given no further information as to what level this phase out, at what point it will be completely phased out or what the phase out might look like. So that's kind of, to be determined. And then last on this list is something that, I think most people are aware of, that when the TCJA was passed in 2018, eliminated lifetime exchanges for all lifetime property with the exception of real estate. And within the last couple of weeks, we actually received the real estate regulations, the proposed regulations from the IRS on defining what real property is. But under Biden's proposal, this could very well eliminate, exchanges and potentially expose people to gains on real property if their income is over $500,000. On the next slide, I've outlined just a few of the tax cuts and credits for middle and lower income taxpayers. Could you go back one slide, please? Thank you. So many of the provisions, the tax cuts are not just, rather the tax proposals are not just for high net worth individuals. There are a number of tax cuts and credits for middle and lower income taxpayers. Many of these provisions I call family friendly. For example, There'll be expanded child tax credits. Currently, qualifying child is a parent of a qualifying child would be eligible for a $2,000 credit or a $500 credit for other dependents. But under the Biden proposal, those would be expanded to $3,600 for children under 6 and $3,000 for children aged 6 to 17. So that's a much more significant credit for those people with multiple children. There'll also be an increased child care and family caregiving credit regime, wherein the child care credit will, for one child, will be $8,000 and $16,000 potentially for up to 2 children. Not to mention a $5,000 credit for family caregivers, which is an area of law that we haven't seen before in terms of giving credits for a family member. In addition, there'll be new homeowner and housing credits, the $15,000 first down payment credit, a distressed community renovation credit, and the first of its kind, a federal renters credit. We've seen that on a state level, but we've never seen that on a federal level before. Last but not least, we're going to see provisions to make retirement plans more accessible to those who can't afford to fund them or those who are unable to actually make a contribution because of their status. For example, a caregiver would be entitled to make retirement plan contributions, and there might actually be some credits as opposed to actual deductions, credits for funding your retirement plan. Next page, please. Next slide. So, what do these proposals under a Democratic administration mean to a high net worth taxpayer? And if I can say this, folks, let's look at the worst case scenario, where all of the aforementioned proposals become a reality. The chart on this page shows the top tax rate for various types of income. So you've got long-term capital gains, and at the bottom, qualified dividend income. Presently is subject to a maximum rate of 23.8%, which is 20 plus the 3.8% Medicare tax. Well, under the Biden proposals, long-term capital gains will be subject to a top rate of 43.4%, which, in pure percentages, I mean, obviously it's over 100%, almost 100% increase, but it's 19.6% incrementally, and that's a pretty significant change. And by the way, those changes don't include the P's limits or the 28% cap on deductions, which are essentially hidden types of tax rate increases. So just be cautious that this is just based on the proposed table rates. Ordinary income, such as interest and portfolio income, will be subject to a 2.6% higher rate, the difference between 37 and 39.6. And ordinary income, those who are self-employed, I mentioned before that there'll be, the donut hole and then the additional tax for those people who are wage earners. Well, self-employeds are going to get the brunt of that, and that's really going to be potentially an additional 12.4% tax over the current tax rate. So you're at 55.8%. These rates that I'm describing in this table really don't factor in state and local taxes. So if you're, as an example, I practice in New York City. If you're a resident of New York City and you are a high earner, you're earning more than $1 million in self-employment or wages, or self-employment rather, you'd be taxed at a rate in excess of 65%. And California residents on the other coast have a similar problem. So, the question is whether or not those state taxes would be deductible. And clearly Biden has a position. He hasn't made it clear, but most people would argue that he's in favor of repeal of the assault deduction cap of $10,000. And in fact, there's many states who are presently suing for relief, but none are expected to be successful. So when you factor in the federal tax and the state income tax, and the sales tax and the real estate taxes and all the other taxes that we're taxed on as a society, we could very well be the highest tax citizens of any nation. Next slide, please. So what you've been waiting for, I'm sure, is some planning ideas. I didn't have to tell you that we're expecting higher taxes. So, what is it we recommend? And I'll just caveat, I think, as Grethell did, not all taxpayers are the same. So it's important to consider your personal tax situation. But here's just a few items to consider in a period of rising rates. And, this first slide that we're going to talk about is really just for those taxpayers who are in the highest tax bracket now, for example, and, expect to be in a much higher tax rate in the future. If you truly believe that tax rates are going to go up in the future, whether it be 2021 or beyond, these are some of the strategies you want to execute, right? You may want to consider accelerating your ordinary income into 2020 so that you can take advantage of what appears to be the 37%, and the 20% rates are the lowest rates we've seen in quite a long time. And of course, defer those deductions. As far as long-term capital gains are concerned, most people who are invested in the stock market have experienced tremendous appreciation over the last decade, and clearly over the last year they've seen incredible performance in their portfolio. So this could really be an opportunity to take gains and to look to balance and diversify, rebalance your portfolio and diversify. There's some considerations there. Obviously, the investment consideration. So you don't want the tax tail wagging the investment dog. But you really, Ed will cover this when he talks about the estate planning. But one of the considerations is whether or not you're going to get a step up in basis if you were to die with these assets. In many cases, people are reluctant to sell their appreciated securities in anticipation of the fact that they may get a step up in basis in the future. So this might really be a good opportunity and a consideration in your going forward planning. And of course, if you're willing to accelerate your gains into the current year, it wouldn't really make a lot of sense to harvest losses. So you would want to defer those losses into a future year. This could make more sense if, in fact, you think when, the capital gains rates will be no distinguishment between capital versus ordinary, then the losses in your portfolio would be, more valuable in the future. As far as other ideas as to how to accelerate income, a Roth IRA conversion is really a great planning tool. If you were already considering doing this, this might be a perfect opportunity to pull the trigger on doing the Roth conversion. It's something that could be done in a very easy fashion. Obviously, you'd want to do some, calculations as to how much. It's not an all or nothing approach. You can, you can actually select how much you want to convert in any given year. I think it's definitely something worth going through if you haven't already done that. Last but not least, this is a strategy that's been, that we think is, a valuable strategy that's being done for generations, is to shift your assets and your income into family members that have lower tax brackets. And so this long term, this is really a great opportunity to not only reduce taxes, but to transfer wealth. Next slide, please. For those people who are not in the highest tax bracket, the strategies I just described may not work for you. So if you're not in the highest bracket today and you don't expect to be in the highest tax bracket next year, you need to consider, whether or not it makes sense to accelerate income into the current year and paying more tax than you would otherwise have to pay. So the emphasis in your planning should be really on doing projections on a multi-year tax bracket planning. It's all about the tax brackets and, making sure that if you do a multiple year projection, that you can really see whether or not the shifting or deferring of income or accelerating deductions is going to be beneficial to you. So the conventional wisdom is that you should defer income and accelerate deductions if you anticipate that you're in a higher tax bracket this year versus next year. And you should harvest your capital losses and offset gains. And of course, you should take advantage of the 0 and the 15% tax brackets on your long-term capital gains. If your income is low enough for you to be eligible for those. You should consider income deferral techniques. I'm not going to get into a lot of those because oftentimes I think Grethell had actually covered a couple of them under the business as to, deferring billing your clients and things like that. But so I'm not going to focus a lot on income deferral techniques, but I will get into more of that actually at the end of my presentation. And of course, you want to consider maximizing your deduction in 2020. Next slide, please. Just drilling a little deeper into the tax deductions. Again, there's only 3 weeks remaining in the year, so it makes it a little bit challenging to do things that you may or may not have done or have the ability to do before the end of the year. But if you're a wage earner, there aren't many things you could do in the first place, given your profile. Unless you itemize your deductions, which we'll talk about at the end of this slide. For the most part, you want to fund your deductible IRAs, even though you have until April 15th to do so. You want to, if you can't, you can consider Roths and non-deductible IRAs. And of course, if you haven't maximized your 401k yet, you want to maximize that if you can make a change between now and the end of the year. You want to utilize all your funds in your flexible spending account or fund your HSA if you haven't done so already. Those are some of the ideas for wage earners. For self-employed individuals and business owners, and I think, Grethell, she pointed out many of these already. You want to consider prepaying any of those expenses that you could in 2021 in 2020. What I wanted to share with you on the retirement planning, which I think is something that a lot of people are not aware of, is that in the end of 2019, December of 2019, Congress passed what was called the Secure Act. And the Secure Act made a number of retirement planning changes that, too many to go into here. But what I wanted to point out was that they made a change to your ability to start a retirement plan, a defined contribution or a profit sharing plan. In the past, if you were a business owner and you wanted to set up a retirement plan, you would have to do that before December 31st of the year in which your tax year ended. However, under the Secure Act, they gave you the flexibility to actually not only start a plan after the end of the year, but to start and fund the plan up until the due date of your tax return with extensions. So this is really a very powerful strategy if, in fact, the year is already over and you can then make that decision at a later date. Grethell mentioned placing assets in service, through bonus depreciation and Section 179 deductions. But what I wanted to also add to that was that, you need to weigh the pros and cons of losing your Qbi deduction, which I think, Grethell made a point of saying that this is a permanent deduction, that once you miss it, you can never get it again. So you want to weigh the pros and cons of that. And you want to weigh the pros and cons of creating an NOL that might be used elsewhere, either through a carryback or a carry forward. And I'm going to talk about that and the CARES Act in a moment. And last but not least, what you have the most control over from an itemized deduction perspective. Since all you really have is, from an itemized deduction is real estate taxes and state taxes, which are both capped, and, interest expense. The third leg of that stool is charitable contributions. So let's talk about charitable contributions on the next slide. You've all heard about the bunching technique, where if you're eligible for the standard deduction and the charitable contribution is the only thing that would put you over that $24,000 or $12,000, depending on whether you're married or single, that you should take advantage of bunching your charitable contributions. However, the CARES Act created a couple of changes that you should be aware of. Number one, even if you take the standard deduction, you still get a $300 above the line deduction. Obviously, it's not a huge benefit, but for 2020 only, there was actually a change that was made that would increase the AGI limit for cash gifts to qualifying charities to 100% versus the 60% that it was under TCJA. So that could, create a very huge opportunity if you had the wherewithal or desire to make gifts to charity. Those contributions over and above those amounts could be carried forward for 5 years. Just be aware of the fact that it's really cash gifts to qualified 501c3 charities, and that if you're, considering doing a donor advised fund or a private foundation, it's not eligible for this expanded increased limit. But regardless, cash, might be king, but in the tax world, making gifts of cash is really the most tax inefficient way to make a charitable donation. The most tax efficient way is to do appreciated property so that you can avoid the gain on the appreciation. Because the reality is that if you were to sell that security, pay the capital gains tax, you'd have less money to give to charity. So, clearly it makes more sense to give the appreciated securities, and be mindful of the fact that even with today's, incredible market performance, the security needs to be long-term. It cannot be a short-term security to get fair market value deduction. So you need to hold the asset 1 year and 1 day. Next slide, please. So the CARES Act was passed on March 27th, 2020, and this was in response to the pandemic. And the Act created a number of tax incentives for taxpayers that were both retroactive to 2019 and included 2020. 2 of those were the suspension of the excess business loss provisions, 461L, and the suspension of the NOL mandatory carry forward rules. So both of those provisions, which allow you to take advantage of losses in 2019 and 2020, will expire at the end of 2020. So it's really important that, if you have losses in 2020 or you're anticipating, generating deductions which would create losses, this might be the last opportunity to take advantage of both of those provisions. It's a very complex area. We're not going to get into the details of how they work, but we recommend that you consult with your tax advisors on the best use of these deductions before the end of the year. In addition, Grethell mentioned the deferral of the employer's Social Security tax, but just be aware that this also applies to self-employed individuals in addition to businesses and pass-through entities. So to the extent you are Schedule C and you have wages that you're paying to employees, or your social, or rather your self-employment tax on your earnings is also eligible for this deferral of 1/2 of those taxes. And last, but obviously, if you deferred your RMD, that could actually put you in a better tax situation this year, because most people haven't taken theirs. However, just be aware that next year you're going to have to take RMD, and it's probably going to change your tax situation and potentially put you in a higher bracket next year. And last but not least on this slide, I'll just point out, a lot of people were unemployed and were laid off unexpectedly in 2020. And fortunately, they were able to receive the $600 unemployment, weekly unemployment benefit. But if you add that up, along with all your state taxes that you may have, state unemployment benefits that you may have received during the year, my guess is it's going to be about $25,000 if you're still unemployed at the end of this year. So I think it's important that, there are no surprises and that you anticipate that you're going to owe tax for that. Next slide. And my last slide, I just want to share a few final thoughts on what I call expectations and opportunities and solutions. And I just also have an outlier at the end of the page I want to just point to. From an expectation perspective, you should expect that under the Biden administration, there's going to be a number of alternative energy credits and benefits, one of which is the restoring the full electric vehicle tax credit, solar investment tax credits, and credits for residential energy efficiency. So to the extent that you haven't bought a Tesla yet or an electric vehicle, you may want to purchase one next year. And obviously any home improvement plans, you should wait till next year. On a qualified opportunity zone, Biden administration is also looking to reform the QOZ and to limit the benefits, in 2021. So I'm not going to have time to go through all of those changes, but to the extent you can take advantage of those before the changes are enacted, it's something that you should look at as a high net worth investor. There are a number of other solutions that I'm not going to get a chance to talk about, but we should all be mindful that these are still viable alternatives that really need to be looked at. If you're thinking that the tax rates are going to go up, at least for the next 4 years, potentially 8 years, how do we get over those 4 to 8 years by minimizing our tax liability? Well, there's a lot of different planning opportunities in retirement, life insurance, annuities, qualified small business stock investments. And the last thing I want to mention before I go is, for those people who are on the call who are in Florida, it's probably not as relevant for you, but for people here in the tri-state area who are working from home, possibly working in another state that is not New York or the state in which their employer is, there's been a lot of issues with regard to state income taxes and working from home, and I just I'm sort of concerned about that because all the states are vying for new revenues, and I expect that there's going to be a lot of litigation and potential perils that taxpayers may be unaware of. So to the extent you are one of those people, you really need to investigate what your state tax liability might look like for 2020 and beyond. So on that note, Ed is going to cover some of the estate and gift planning. But before we do, Ed, do you want to handle the next polling question?
Yep, we're going to have a polling question. Thank you. Appreciate it, Gary. The last polling question: have you or will you make large taxable gifts in 2020 in anticipation of a reduced lifetime exemption and a state tax reform in 2021? It's a yes or no question. I'll give you 15 seconds to answer. Okay, 86%, the overwhelming majority said no. So, that's interesting. And it again, when you're talking about estate and gift, as Gary was saying, and everything that's going on right now, the uncertainty and taxpayers all are a little bit different. As you know, we're closing out at 12:30. We wanted to have a little time for question and answer. So I am going to be very brief in my comments, especially given the fact that, again, as Gary stated, it's currently December 10th. We have 21 days left in the month. We have holidays and everything else in between. And currently, depending on what type of property you want to gift, valuations and attorneys right now are at a premium. Because they're all working very hard, finishing things up already in existence. So if you haven't gone forward, it may be a little difficult. But let's look in currently to what the Biden plan has to say. And to refresh, the current exemption is 11.58 million or 23.16 million, for married couples. And it's already been announced that that exemption is going to go up to 11.7 million per person in 2021. Now, the pandemic increased the wealth, according to various studies that have just come out, of the top 1% and certainly the top 0.1%. So public sentiment may be toward, increasing the estate tax rate and decreasing the exemption in any event. But what the Biden plan has said, JoeBiden.com says they want to go back to 2009 levels. And what were 2009 levels? Well, it was a 3.5 million per person exemption. The website's silent on gift taxes and silent on GST taxes, but we have to assume that, the unified system is going to try to remain intact. So those will probably be at 3.5 million as well. And rates will be at 45%, although there have been conflicting statements by other Democrats looking to go on a much more progressive rate structure. So that may be possible as well. Gary touched on the no basis adjustments, but there are a number of tax policy issues that go back a long way, linking step up in basis to estate taxation and paying tax on assets at fair market value at death and then not getting the step up. In addition, depending on how it's structured, if they're talking about people over a certain level, you may create a real paperwork nightmare. So I don't think they're going to have issues with that, and I think that is going to remain. But again, it's a wait and see. What's going to happen if nothing gets passed this year? If Republicans remain in control, there may be slight changes, but I can't see them making any change to that if they remain in control of the Senate at this point. So what will happen in 2025 if nothing passes? Well, the exemption drops back down to 5.6 as adjusted for inflation. So it'll probably be closer to $6 million per person. And people are also worried about, clawbacks. You've heard clawback issues. In November of 2018, proposed regulations were issued basically stating that, if you use the exemption now, they are not going to come back and go after it. And I don't know if they could at that point or not. But what it basically said is you're going to be able to use the greater of the basic exclusion amount either used during your lifetime or that it exists at death. So let's say, for example, you don't have or you don't feel you have the wherewithal to give away $11.58 million each, but you and your spouse may have the ability to give away $10 million combined, $5 million each. In that regard, you give away the $5 million each, or one of you gives 10, and at that level, you're going to be okay using that amount. Sure, you won't get the excess available to you, but you will have been able to use at least $5 million of the exemption instead of $3.5 million. So just some different thoughts and looking at different options. So what is there to do if we go to the next slide? Again, when you're looking at items right now, every estate planning item is probably on the table with the exception of probably creating new entities, new investment partnerships and things along that line, because you won't have time to establish them and then make the gift before the end of the year. And you have to look at what may be available as far as your attorney's time as well. Like I said, a lot of the attorneys that I've talked to at this point have been very, very busy. The easy solutions, though, are obviously making outright gifts. All right, you just make outright gifts to your children, your grandchildren, or whomever. Creating a simpler dynasty trust or descendants trust. And making gift to those. And to the extent that you already have existing trusts that you created, if you find that they are in good shape, then it might be a good time to just use those as well. Another easy one may be creating an irrevocable life insurance trust and funding a large single premium life insurance policy right now. Some harder solutions, but ones that, again, are still available and on the table for people that may not feel like they have the ability to give the full amount, are the SLATs, the Spousal Lifetime Access Trust. All right. It's a trust that is created that your spouse still has the ability to retain the income from. It is a grantor trust for income tax purposes. So, from that standpoint, you have to be careful and make sure that your spouse is still going to be your spouse, given that the 2017 Tax Act repealed Section 682, which, would have had the spouse being income taxed on the proceeds that went out. Instead, it'll still be taxed to the grantor. Slants, which is similar to a slat, except it's a non-grantor trust, that can be a very tricky thing to draft, so you have to be very, very cautious. An inter vivos Q-tip trust, you can, again, create a spouse for your trust, which requires all income to be distributed to your spouse. So again, you get the use of that, but you make it a completed gift. It does give you an extra 9 months to figure things out, because in inter vivos Q-tip trust, you're going to have to elect Q-tip status on the gift tax return. And, if the law changes, then you will not want to make that election. And if it does change, you may consider making the election to get that increase in basis later. Obviously, because all income of that trust has to be distributed out, there will be some leakage. There are, the other normal things that you can do that have been out there for years and years, grantor retained annuity trusts, charitable trusts, qualified personal residence trusts. May not be the best time to use, certain of those vehicles right now, but they still are available to be used. Going on to the next slide. Some considerations that you'll want to look at. How hard are the assets to value? Again, this goes to the difficulty of getting things done before the end of the year in what you're going to do. If you have existing entities, you may be able to distribute a certain portion of those. You may have to use a formula type clause to make certain if the IRS challenges your valuation that you're okay. But again, that's just one consideration in talking with your advisors on. Using a grantor trust. Grantor trust right now, you as a grantor trust, you are still considered the owner for income tax purposes. So obviously, you can have the swap power and make a, contribution to a grantor trust now and look at swapping assets out later. And that's one of the easiest things I think to do right now. You can think about what you're giving as far as the basis of the gift versus death and everything else, but the swap power allows you to make changes as you go forward. Going on to the next slide. Some afterthoughts on the potential Biden changes. If you go back to Obama's 2009 Green Book, short-term grats may be on the chopping block. Grantor trusts themselves were an issue back then, although it's going to be very difficult to do away with grantor trusts, I believe. And if you're not sure about the terms of a trust right now, talk to your advisors about having a trust protector put in to change provisions or to be able to decant the trust later. Give a power of amendment for amending in 2021. It's a very difficult time, and unfortunately, I don't have a lot of time to get into other issues. We have to end here as at 12:34. Are there any questions? And have you posted to the Q&A during the program? Again, these are this slide shows our email addresses. Please feel free to send us any questions on anything you've heard today as well. Well, with that, again, please email us. Our email addresses are on there, and or ask your MBAF advisor that you work with any questions, and we'll get them back to you. And thank you all for attending today, and we will talk to you later.